Trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
All right, and we are back with Chris. Hey, Chris, how's it going, man?
It's great, Nick. Happy Monday, man.
Good to have you back on the show. And again,
Thanks.
I was prefacing today that this week is huge in terms of market potential volatility. You've got everything from FOMC on Wednesday, jobs Friday. I believe it's Tuesday we have Amazon after the bell. And is it Thursday that we have Apple after the bell? I mean, you got earnings and everything. Yep. I mean, it is a crazy week. What's your high level view of this week as we get into it?
Yeah, it's exactly that. It's expected to be super volatile. I mean, we're wrapping up a month. We've got 913 companies reporting earnings. We're kicking off with the Fed on Wednesday, non-farm, like you said, on Friday. So I've got some notables right here. We also have a lot of semiconductors. And I mean, again, this is what's rallied the market a lot this year. Let's just take a look at some of the notables. Bitcoin as well. We're going to have some correlations there. So MicroStrategy today aftermarket, that'll be a big one to watch. Coinbase is later on in the week. Coinbase is aftermarket on Thursday. We also have Tuesday, a little fintech with PayPal, some consumer, I mean, I don't know if Coca-Cola is probably a blue chip just because of dividends and it's lower volatility. McDonald's, health of the consumer, good or bad. Eli Lilly with Ozempic, one of the bigger crazes. So it hasn't been semiconductors, but Ozempic has been Eli Lilly's bread and butter there for this big epic rally it's had. Then we get into SMCI, which actually was one of the top performing stocks in 2024. Just came out of nowhere, shooting up like 200+%. And then it joined the S&P 500. So SMCI likely to have some volatility. That's Tuesday after market. AI, it's in the AI space and semiconductors. Advanced micro devices, same thing. Amazon, like you said, aftermarket on Tuesday. Riot is a Bitcoin miner. Pfizer for big pharma. MasterCard Health, the consumer. We talked about Visa last week. Barrett Gold. I still don't think the miners have really caught up in any way, shape, or form. Like gold mining has not caught up with the actual spot price of gold. And I don't know if it's the best trade to be long miners, even though it's like dirt cheap and value wise, it seems to be where the catch up trade could be. But anyway, just thoughts on that. Let's see here. Thursday is a big one. A lot of the earnings this week, Nick, are going to be Wednesday and Thursday. I went to my calendar update here. So let's go to where a majority of the earnings are coming out will be Wednesday and Thursday right here. So we have 274 companies.
You got Apple on Thursday. So that's a big one, obviously.
Yep. Thursday after market. So 274 on Wednesday. And this is all going to be digested during the Fed. So it's 2 p.m. Fed rate decision, which is pause as expected. 2:30 press conference with Powell. Thursday, after market with Apple, 318 companies, which is most of the week. So literally Wednesday, Thursday is dumping in almost 600 companies of the 900 reporting. So you have 2/3 of the week just on Wednesday, Thursday alone. So yes, needless to say, it's going to be a very highly anticipated week. So I'd like to get into the charts because I still think let's look at the NDX, for example. So if you go to the weekly time frame, a couple things happen with these Fed weeks, right? The NDX had such a massive sell-off 2 weeks ago that I could still see, even with the Fed this week, that we could have high volatility, but we don't necessarily do any damage to that previous sell week, right? Last week was a recovery. Last week kind of stabilized. I still think this is a high, low, lower, high, lower, low scenario from the technicals. But I don't know if we're going to push and make fresh lows this week. It's going to be nuts, man. It's going to be something that's difficult to position for, and it's going to be so fast and so furious that I was telling Frank offline that, typically with a big earnings week, I'm pretty excited about getting in some strategies that I can, go long straddles, long strangles, reverse iron condors. I can trade some volatility breakouts. But I think that these moves are going to be so fast that I don't necessarily want to pay a bunch of money for debits and then have to be, jumping all over the place to manage these positions. So what I think I'm going to try to do is look at a more cost-effective way to tackle earnings and go in the money, do some credit spreads, try to collect 70% on the dollar premium. And that way, if we have an earnings move that's beyond expected or right around my expected move, I should be able to collect, some net profit regardless and take a very small risk. Like for me, I could grab, let's say, 70 cents on the dollar, risk 30 cents. I lose one, win one, walk away positive by maybe 20 to 40 cents.
Yeah.
So it,
You know
it
what,
doesn't
what's
take a lot,
interesting,
but
Chris, too, is I think that this week, when you have so many things around the corner, like constantly, what that would lead me towards in terms of a bias would be if you see a profit, take a profit kind of environment.
that's a
Because
good plan.
again, when you have the S&P popping big on Amazon earnings, or let's just say, if Amazon blows it out of the water, it pops open on the next morning. In my personal opinion, just from watching how the markets will, there's such a 24-hour news cycle.
Yep.
On that next day, you probably sell that. You get out of the way of the Fed meeting, because again, there's probably correction, there's probably profit taking, there's probably a lot of kind of resetting throughout the week for all of these big events. So I think that's tricky, because I think the follow through will have a little bit of shadow of a doubt everywhere it goes, just because you've got so many potentially market moving things that could whipsaw things back and forth. So should be a really interesting week. I would say, the biggest one in is probably going to be the Fed.
Mhm.
Because the Fed, here's what I'm thinking with the Fed right now. We've just had so much more evidence that rate cuts are going to be hard to come by. The jobs
Yeah.
data, we do get more of that on Friday. You had PCE last week was hot. The issue that I see is that the market is wanting cuts, and even the Fed themselves wants to cut rates at some point, but we're just not seeing the evidence of that. And the market is getting short term all hyped up on tech earnings, which I do think is, a very important, that's going to be your leaders. But if the overall story is higher for longer, and we
Yeah.
continue to see that theme, at some point the market's going to wake up and say, oh my goodness, so rate cuts are really not coming until, you know, September, but maybe even past that, right? Do we even see a rate cut this year? That's look at the trend. The trend is not in your favor if you think rate cuts are coming in September. But we'll see.
Yeah, and speaking of the rate cuts and the forecast, I mean, it's interesting that the Fed's kicking off May 1st with here's the tone we're going to set for probably the rest of Q2. I am curious if Powell takes the initiative and kind of sets the tone for the rest of the year. I know every Fed meeting, every press conference, he pretty much talks out of both sides of his mouth, and we will cut if we have to, we will raise if we have to, blah blah blah. And the
Yep.
market's like, what do we do? So here is September. This is what the CME watch tool or the Fed watch tool is looking for. This is probably the thing that I would watch for the closest by the end of the week to see how big the shift is in expectations. Because right now, Wednesday, 97.3% chance nothing happens. That's very likely the case. It's probably you could forecast that and say I am Nostradamus and I'm predicting that the Fed won't cut rates because it's pretty much baked in.
Yeah.
And then going into June, also, 88.4%. That's probably not going to shift too dramatically. July, summer trading, also probably not going to change. September, this is what I'm talking about. It's 44% that there's still a sliver of a potential rate cut coming in September. I still don't think that it makes sense to cut in September and then have an election within a couple of months.
Yeah.
So that's why this is probably what I watch the closest, because if this all of a sudden shifts where by Powell's messages this week, let's see if September has a big shift. And if this is down and this is up, then we are definitely kicking out the thought of rates until probably 2025.
Yep.
And that I don't think is going to bode well for the stock market as far as tech, as far as small caps. I think it's going to be struggling. That being said, we have to remember that the SPY and the Qs, they are market cap weighted. And when you have market cap like an Apple, like an Amazon, now an SMCI that's come out of nowhere to be one of the best performing stocks of the year. You got Nvidia up there as well, which came back in a big way last week.
Oh, huge. Yeah.
Those stocks are big enough and they are volatile enough and they move quickly enough that can still drag the markets
Yes.
higher or at least stabilize the sell-off. So I think traders need to be aware that because it's so concentrated at the top with literally 5 stocks or 10 stocks, just because we have higher for longer, we could see that the broader market, like the S&P 490, is underperforming while the top 10 still perform well. And that's what 2023 looked like with the recovery.
Yes. Yes,
So,
exactly. And I think Chris, you've outlined kind of where I am most bullish. And I think that if I could show you this chart here for a second on the S&P.
yeah.
So my thought process on this is we're coming up to resistance here. But as you've mentioned, I had to explain my positioning because it's kind of complicated. I am bullish, and you know it well. I am bullish overall, but I think that there was some good merit to this sell-off. Again, I think the market does not want to believe that rate cuts are not coming as easy as they think. So that's a big story. But what's bouncing it back here, and what I've pointed out as my line in the sand here, is this level on this SPY, the S&P. If 5150 gets broken out, and let's just say it's Amazon earnings or whatever it is, at that point, we may be seeing a V up recovery. My basis for this is I'm bullish, but I don't think a V up recovery is what we see. That's been where I've been at. But we've got higher lows here. We've seen, breakouts of market resistance levels. And if we continue to see that pattern at some point, I probably just say, hey, this thing looks strong. That being said, though, again, we got to break out of this key level. And this morning so far, this level has been pushing back a little bit on the NASDAQ and the S&P 500. Also, Chris, I want to get your thoughts on gold here. Gold's had a big run up. And as you were joining the show, I was pointing out that arguably one of the things that gold might be traveling up on is clearly not just, yields, because yields have been up. So, one of the things that I've been thinking about for gold is perhaps there's just this desire to diversify from big money into something that's not so correlated to everything else. One beauty of gold and, silver is that it has the potential to be less correlated to other assets and does typically go up over time. So is there this push for a move into gold, not just from US investors, but perhaps foreign investors, foreign central banks? Is there a desire to get away from the dollar? What do you think?
I mean, I think that's what was the secret little run that we had on gold this whole year. Was a lot of it was it's central banks that are buying gold like crazy. It is definitely a slight position away from the dollar. Again, this could be a very odd year where gold is up, dollars up, equities are up, yields are up. That's one thing. So when you took your TLT position, I did the same thing. I'm long TLT, but I'm out to 2026. I'm trying to give this market plenty of time to then kind of right the ship. And so I jumped onto the session and caught your discussion around, what would peak investor interest to get kind of out of the traditional equities run and go more into a fixed income safer play. I mean, if we look at, I could log into my Schwab account and take a look. I'm pretty sure right now you can still get certificates of deposit, money market instruments, and treasuries for over 5%. And the treasuries probably have the biggest shift. If you're willing to lock up money and make it's illiquid, but if you lock it up for, let's say, 12 months, you can still pretty easily get a 5+% return for, it's not risk free, but it's as good as it gets as far as taking very, very low risk on these trades. And for 12 months, I mean, I don't mind locking up capital for 12 months and having it be, illiquid for that period, but getting 5.5% yield. So let me log into Schwab. So we're looking at gold right now. Nick, do you have a technical spot that you like on gold? I'm kind of waiting a little bit longer to see if gold will maybe play a slight pause a little bit longer. I'd like to see if gold can just kind of hover in here, maybe try to create a couple of floors that I could buy from, as opposed to just thinking like this is the dip. I don't think that this is necessarily the dip. If we came a little bit lower, I can wait for a trend line break. But this is why I'm not in a hurry for gold, because I like silver better. We've talked about it. I like the technicals on silver more. I think silver has more upside potential as a percentage. But if we can establish some good structure on gold, let's say that this, 2275 is all of a sudden getting, tested. Well, then I get long at 2275 because I have the evidence to do so. But right now it feels like one pause, I'm getting back in. I'm not in a hurry. I'm not in a hurry considering silver is such a better technical trade for me.
Yeah, and I've made that point, 5,000 times. But one of the big reasons I like silver too is because it has more of a industrial demand. It's actually used in like everything. Whereas gold, it's really that risk, that safe haven kind of materials. So I like silver too. I think that if you're going to see this environment where you have high inflation but also strong economies, I'd prefer silver over gold. If you see something shift where the economies are sliding but inflation is sticky, that's where you'll probably see me jump right back into gold. So I'm kind of watching that story pretty close. On that front. Another one is oil. Oil has come down off of its recent highs around 87.50. So we have seen a bit of a pullback there. Oil is an interesting one to keep an eye on, guys, because remember that oil, even if you don't trade it, it's an incredible indicator for inflation, right? Energy costs, transportation costs, shipping, all of that stuff, whether you look at the core CPI or just the CPI, right? The core CPI, it makes an effort to strip out energy and food prices, which are volatile. But if oil remains high, even when you use the core CPI, this still factors in, right? It still trickles in because everything costs money and prices will go up if oil prices are high. So even if you're just looking at the core CPI, trying to say, oh, I just want to see inflation on key things, oil can be very impactful to the overall story for inflation, and it's something that the Fed can't really control, right? If oil prices are flying high, that can present a problematic story for the higher for longer scenario. So keep an eye on oil. It's really important to the markets right now. We are seeing a bit of a bounce off of this 81 area. Chris, you and I talked about this last week. You think this has room to push back up and retest this 88 area?
I do. I'm pretty bullish on oil's posture overall. I think if oil, as long as we stay, to me, as long as we stay above 77.50, I'm still pretty bullish on the structure overall. It's surprising that oil hasn't gone up faster and higher with all the stuff going on in the Middle East right now. But I mean, 81 or $80 on the nose might be a little. I think that gets tested, right? If we have a little pullback, we find channel levels, we might breach this level for a fake out. That could be like the bear trap, and then this rips back up. But like I said, to me, if we're invalidating this bullish channel, to me, this is price coming back below 77.50. So I don't see that happening. I think oil is still really well supported around this $80 handle. I'm looking to retest the highs. I think range wise, we go all the way back up into the 90s again. You'd mentioned the core CPI too. The one thing that also is a very sticky part of inflation and just high costs is shelter. I know shelter's lagging, and I know that trends are showing, lower shelter prices, but housing wise, real estate wise, people aren't going anywhere. I mean, I think there's less moving. Rates right now are still sitting above 7% for the 30-year. And yeah, I mean, if oil goes up, it's going to be hard. And then the conversation, I think, shifts where it's like, is it a hike? Is the Fed going to hike to really like just squash this altogether because they're going to throw another 25 to 50 basis points out there? I don't think the
Right.
Fed wants to hike. I don't think the Fed wants to cut. I think the Fed is like fingers crossed that nothing breaks. They have to come back in and do something like intervention wise. Speaking of intervention, I'm sure you talked about the yen this morning, right?
I did briefly. Yeah. So
Yeah.
so you had what are your thoughts on that? Obviously, big swings both directions here.
Yep.
My quick opinion, Chris, is I think that we've seen this story so many times. The Bank of Japan comes in and they say, "Oh,
Yep.
well, I don't even think they said anything. I think there's just rumors, right? There wasn't a formal
Sure.
announcement. I think it was
Sure.
just rumors of dumping dollars, buying yen kind of stuff."
Well, this is so I looked at it this morning, and it still doesn't really change my opinion. I mean, yes, we had a 500 or 600 pip swing just today with all the yen crosses, and that's ridiculous volatility. And again, it goes what we keep talking about. You can't plan or trade around that. Like the spike to 160 happened in a minute. The spike all the way down after that happened within 15 minutes. We've had such a ridiculous amount of volatility in such a short amount of time. For the traders last week, they're like they're going to intervene. It's like, well, how do you position for that without getting stopped out in a flash crash type move? And
Right.
not only that, but in 2022, when we did have actual like statements from the BOJ saying they're intervening, right? And it happened 3 times, and it happened over like a 6-month period, and it didn't put the high in. It's like we had a high right here that went up another 500 pips. Then we had another high to low and another high to low after the fact. That was end of the year. So if this is maybe step one of the rumor of intervention, it possibly doesn't take shape effectively. And I'm still here's where I'm proven wrong. If I'm dead wrong on this yen stuff and the BOJ is intervening to a huge degree, then we're talking about the dollar yen. Nick, you and I would see the dollar yen down here and have a conversation about selling and seeing that the Japanese yen is truly getting stronger and now it's time to start looking at position for sell trades. But if we have just a giant indecision candle for the week and a lot of volatility, price can trade inside that for days and days and days ahead where there's not a high or low broken. We just have a 600 pip range this week.
Right. Yeah, for sure. I mean,
So it's tough.
totally. Yeah. And I think that for me, it's just the pattern of, the theory around yen or Japan intervening in the currency exchange. Historically, it's just like it's just been bullish. Like it's a bullish environment. You would think it would be the opposite. That's what everybody thinks. And then you get these blips and they get bought, and then oftentimes they're just back to the highs pretty quick. So for me, I think that dips on the dollar yen until proven otherwise are mostly bullish. The story for the dollar just looks really strong overall. And I don't think that the Bank of Japan can change that factor, right? That's not something that they can control, is the strength of the dollar. They can try and help their own currency. But again, until broadly speaking, I'm more bearish on the dollar. The dollar yen looks pretty attractive to the upside in my view. Chris, I just want to thank you for coming on really quick. I'm going to let you keep taking over the show for a little bit. For everybody who's hanging out with us, Chris comes on the show regularly. He contributes. He also takes over the show for a little bit. So stick around here. He's going to be going through some more charts, going through his own approaches, strategies, stuff that he's trading. So before I step out, I just want to say to anybody who's listening here live, Chris has his own YouTube channel. We're going to drop the link to that. If you'd like to check that out for yourself, you can subscribe to his channel. He's also got a Discord channel that you can join for free, all that good kind of stuff. Chris, thanks very much for taking over the show. You got it from here.
All right. Thanks, Nick.
All right. See you, man.
Bye. So we'll wrap up a couple thoughts on the dollar yen. I do think that there's your high, there's your low. It's a lot of crazy volatility. I still think that the dips are being bought. If I'm structurally going to change my outlook, so here's the deal. I have robots running that are buying only. So Aussie yen, CAD yen. I'm not trading the Swiss yen because it's safe haven. I'm staying out of that one. But Aussie yen, CAD yen, Euro yen, pound yen, New Zealand yen, dollar yen, all my robots are buying only. So the way that works is my alignments on my systems and strategies have to get buy trades. Pullbacks like this are actually good because that offers my robots a chance to either see a transition from what would show a short-term sell signal. It's not selling. I'm not interested in selling, but a short-term sell signal then becomes a confirmed buy signal, and it buys again with stop losses below that recent U-turn. So if we see that all we're having today is this high, this low, and prices trading sideways, my robots are going to get realigned with buy signals and look to see if we can keep making higher highs. Now, a couple more things on the yen. If we go back to a weekly or monthly chart, 160 is an interesting spot. That there's a high back in 1980, and this is nuts. Okay, but let's look at this from the technicals because this is what I think we have here. This is the high from 1990 at 160. Okay, if we breach 160, there is really nothing stopping the dollar yen as far as major structure. There's nothing stopping this thing until 177. Now, I get it that maybe the round number at 165 or the round number at 170, these could maybe stick and be like a level of, intervention. But when you look at this chart, this is an open space above 160, and there's nothing until this 1978, it's like a 1978, 1979 low. And that's at 177 or 176. So there's still plenty of upside potential for this carry trade to keep happening. And I do think the Bank of Japan is in a rough spot. I mean, the Nikkei 225 could benefit from a weaker yen, but it's forcing investors to be in equities. It's forcing investors to be, pretty much anything they can do to get yield outside of a weakening currency. And it's a tricky and delicate spot. But I also look at this from just simple technicals. This is a textbook head and shoulders. This creating a left shoulder, head to neckline, right shoulder. We had this large buildup of the right shoulder for months and months and months, almost years actually. And I just want to measure this because this is what I'm looking at, and this is why I'm not stopping the trade. If we're going to go up, this is my low to high, okay? And there's two ways that I measure this. We can measure this to symmetry right here, which lo and behold, the intervention that we saw at 152 was right around that symmetry level at 150. Okay, so that was a measure move just from a low to high, higher low to higher high. but the true measurement of a head and shoulders pattern is from the neckline. Okay. So to me, this is a technical pattern in a currency in the Forex market, which is super technical. And we have 175. So I'm not predicting or saying that it goes to 175, but I am saying that from my analysis, it makes sense if we do get to 175. And for me, if I was going to say, Chris, where do you think the dollar yen stops going up? I would say 175 to 177 because 177 was a previous low from 1979 or 1980, and 175 is a measured move from this perfectly like obvious technical pattern. So if I'm going to call a top, I'm giving this thing room to go another 1,000 pips to the upside, maybe more. And if I'm going to call a top, I want to see that we have a topping pattern emerging and we want to be on the right hand side of the trend line. Neither of those have happened right now. So to me, I am in no hurry to say this yen thing is unraveling. Be long the yen. I think that's a terrible decision right now because we're going to see it, intervene and then probably be bought and slowly drift higher and make it more painful for the retail traders that are fingers crossed. They get like that first little like sample of hope that it's like there finally. I mean, yeah, it feels great if you're right in, once in a blue moon with the trade finally going your way if you're upside down in these crazy drawdowns. But those drawdowns to me are just going to get worse. If you're holding trying to fight the end, good luck. And that's the scariest place to be as a trader. If you're fighting and you're waiting for a central bank to be your savior, no thanks. So this is why I'm not doing anything other than trade what you see. I've got robots positioned for it, trading very small. And to me, technicals, 175 to 176 is where I would say this is where I could predict and forecast a technical reason for the market to stop going up. And that does not mean 160 is the spot that I say this is the top. So I think there's more upside potential. I'm going to stick with it for right now. Okay. Really quickly, when Nick was on the show, I was talking about I brought up my Schwab account here. I want to show you just some fixed income plays. Right now, if you are looking at, what, I don't want all this volatility. I don't know what the market's going to do, good, bad, and different. If you're willing to tie up, these short-term certificates of deposit, the little money market instruments, you go to a major bank, go into CDs, getting a 12-month right now, you go out, 12 to 18 months, 5.45%, virtually risk-free. Yes, it's illiquid, but, going out 2 years at 5.4, 12 to 18 months at 5.45, it's slightly off that. I mean, the crazy thing is even a 3-month. I mean, a 3-month that you would just buy back into, the 3-month is 5.45. I mean, that's not too bad. If you are in a position right now where, and this is probably for the older, the older investor or those that don't need to take a bunch of risk or needing to take a bunch of risk. If you want less exposure, then you can play it safe. You can go to the larger banks right now, go to the fixed income vehicles, do the certificates of deposit, money market instruments, do the treasury route, and every 6 to 12 months, it's a pretty good deal. I mean, since 2023, I do have a portion of my portfolio, fixed income wise, like Roth IRAs and traditional IRAs. I have about 20% of those sitting in CDs and sitting in money market instruments and sitting in treasuries to be safe, and then the rest are in some stocks that I'll hang on to. But anyway, I mean, it's kind of nice to know that, look, the average return for the S&P is 8%. That 8% is going to have to face probably a 20 to 30% drawdown at some point. Traders are freaking out that in 2024 we saw the market pull back 5%. It seemed like the sky is falling. This is nothing, right? I mean, this market pullback that we've had is absolutely child's play. And this week with all the news and all the earnings and all the Fed speak, I mean, I don't know what the market's going to do. If I had a crystal ball, we'd position for it. We'd all make a bunch of money together. But what I do feel I can do is I can say that this high to low, if we're going to cap this retracement, we're probably looking at this 51.45 or 51.50 level. And from there, if this market respects that as resistance and we try to make a lower low, then this becomes a nice technical channel to then look for what's next. Well, this level's where I'd be way more bullish on the market. If we come back into 4850, 4800, retest those all-time highs before we broke the all-time highs, retest that level, to me, that's where I could say, okay, now we've got a, close to double-digit correction. It's going to be like 8%, and that's healthy, right? 8% correction, that's 8.25%, give or take. That's a healthy correction in a bull market. We should see, 3, 5, 7, 10% corrections. Any deeper than that, yeah, gets a little bit scarier. If it's double digits, it's a little scarier. But 5%, 7%, 8%, those are healthy corrections. We hit right around that 5% level here. So from all-time highs to there, that's about a 6% correction, just shy of that. And the market is doing what it can to stabilize and fight back. Now, with earnings this week and the Fed, I could see this being a very noisy week where, stocks individually like pop up, pop down, good, bad earnings. I'm not sure, right? I mean, I can talk through an earnings play, and like Amazon's a good one. Frank, you're on here. What's up, dude?
How's it going?
Good, man. Anything you wanted to talk about in particular?
Yes. So I am looking at Amazon
Okay.
earnings.
Yeah,
I know we already talked about it, but I guess just for the audience,
sure.
I'm looking for a lot of volatility in this stock. I don't know if you talked about the big tech earnings already, but we saw Microsoft and Meta and Google all either move 20, 50 points in either direction because of earnings.
hmm
I'm sort of looking at the same sort of deal with Amazon. So like if we look at Meta, that was a big AI trade.
Yep.
Seeing that miss was a huge move for the stock. I think did I say Microsoft?
Yeah, you did. Microsoft and Google were the big
and
ones last week that kind of stabilized the market. Microsoft beat earnings. They beat expectations top and bottom there. And Google was the one that ripped up the fresh highs. Google, that was a huge, that blew through what I expected to see in Google from a 156 all the way up to 170. We're fading that move a little bit, but that's a big gap on Google.
Yeah, I'm looking at heavy volatility this week because of that.
Yep.
And because of we have the Fed talking on Wednesday too. And I was going to ask you what your thoughts were on that, just in terms of what do you think he's going to say. I already have my ideas, but I kind of wanted to hear what you say first.
Sure. I think Powell is the ultimate articulate craftsman. I mean, he will say that it's the same thing we've seen it very consistent, right? I mean, he'll talk about where inflation data is at right now, where the consensus from the Fed is at right now. If it's necessary to raise, it's not off the table. Is it necessary to cut? What's the timeline? They're still figuring it out. I mean, it'll be all incorporated into the speech in his press conference, and the market's going to have to determine what direction they think is a better way to go. Here's what I'm looking at now. I'll just again, let's keep it on the charts. I mean, one thing that's really interesting is if you look at unusual options activity or look at high open interest strike levels going into Wednesday, for example, and this is all potentially going to change as more contracts get thrown in the market. But if I go to Wednesday's expiration, since we have all the indexes now with single day expirations, and then Friday is going to be a big one since it's the end of the week. May 1st, what I thought was interesting is looking at the open interest here. Look at where these levels are at. Right now, it's showing that we have way more call open interest than we do put open interest. And some of the strikes that stand out to me, and again, this is just for Wednesday, but the strikes that stand out to me, 515, which is exactly, if we go back to the chart here, look at 515 on the SPY. It's right here at where that floor was established, that 513, 514, 515 level. If that's tested and then reacted to, so open interest, in my opinion, is either a magnet or it's a slingshot. So if this is going to be what kind of absorbs the move and then slings it lower, I could see 515 acting as major resistance this week. If we go back into the open interest, so we have this 515 that stands out to me, then we have this huge level all the way up to 520. 520 could certainly be tested, but 520 also does not get us to all-time highs, right? 520 is this great recovery, good effort on the SPY, good effort in the broader market. Earnings could be positive to support that move, but 520 does not get us to the all-time highs. And so 520 could also be a spot where good effort, but not good enough. And then we start to fade back down. And it looks like this: high, low, lower, high, lower, low, right? Where it's a close move, but we just have more volatility and chop at the top, which from a technical standpoint would make a lot of sense if we started from a low, had this crazy 5 or 6 month run with virtually no pullback, and the market just takes a break, just takes a little bit of a breather. So I mean, I would like to see this, Frank. I'd like to see that the 513, 514 level on the SPY offers some resistance, just because technically that makes a lot more sense as far as high, low, lower high, lower low. Once this correction, if this correction plays out, this gives real buyers, this to me, this gives real buyers, longer term buyers, a much better opportunity to position for that. So
Yeah,
that's what
I
I'd like
agree.
to see happen. And so I think it
I
gets more
when you
challenging. Yeah, go ahead.
when you talk about 515,
Yep.
that's also around this 50-day moving average that I've been looking at too.
Okay.
Um, I would say like 5150. That's sort of like the top for the week for me, or at least in the short term. I think Powell is definitely not going to say anything dovish, but if earnings also come out, less robust than what we thought, I think
Yep.
that's also going to add. It's going to add volatility either way, but I think this is going to add to the bearish side. I think those calls you said expire on Wednesday, right? At
Correct.
5:15.
Yep.
See, that's a tough one because you kind of want more time for that, I think. If you're trying to get a call and see price of the SPY hit 5:15, you'd probably already want it to be there if it expires on Wednesday. So, um, I'm just saying it's got resistance. It's got the 50-day. Last week's rally isn't an indication that there's going to be a whole lot of upside, really.
Right.
And I'm not necessarily hoping for a huge correction, but it's hard to be convinced of a extremely bullish rally, especially when yields are still at 5% or just hovering just below it. And, there's just a lot of uncertainty around where yields are going to go. So,
Agree. And I think that, the market's been pretty resilient, considering that we have this rally. I mean, yields have gone up and they peaked at 5%. That's when the bottom was in the markets. The yields have gone up. We've barely pulled back off those all-time highs. So the trajectory that the market has sailed, when this retreated, and we saw the October bottom in the stock market and the yield top right here, the fact that the market took that and ran all the way to fresh all-time highs by another, 11% to start off this year's trading. Yes, we faded that back down to about, 3, 4, 5% net. I think now the market's up about 6 or 7% net for 2024 year to date. But I mean, yields are going to continue to probably retest this level. And I see a lot of macro analysts out there talking about, 5, 5.25 to bring the 10-year up to where the Fed is sitting. I mean, the Fed's sitting at 5.25, 5.5%. So if real yields get up to that point, I mean, the thing that's breaking people's brains right now is how can we have yields up to 5.25, 5.5% or making these highs and see the equities market still being as resilient as it is. And this is what I said earlier to Nick. It's probably, if this case where the market really hasn't sold off a lot, it's because so few stocks are just keeping it supported. It's still the Apples. It could be now Nvidia. It could be the AI space. It could be like the concentration of 10 stocks that floats the entire 490. So there's
well, yeah, I
resiliency in the
agree.
market, which is kind of nice to be an investor. But it's like if any damage is done, where let's say this week with we have what, SMCI. Okay, this is going to be a play here where this could be one that I look at. I know there's earnings this week. It may be a little risky to take this trade, but if I went low enough, let's say I went out like 30 to 45 days, Frank. If I went low enough and I said, look, I think that this won't come back to this level because SMCI might be in the same situation as Nvidia, where hardware wise or what they do, what they're offering to the markets, what they're getting into this AI space and this AI race, maybe this is where, a 50% pullback is a justified move to the upside. Maybe. At the same time, why would I be skeptical of this? Because when you have a parabolic run like this, it's nice to see that the market can actually retrace. So this might go what goes up and it might work its way down, but we might talk about SMCI all the way back to where we started this breakout. And then we're stuck here like, what about this AI stuff? And is it a bubble? So I'm just going to be careful on how I position and kind of chase this stuff. So, like I told you earlier before we jumped in the session, I think I'm trying to keep my costs low, my debits low. I do expect a lot of volatility. And I mean, I'm just going to set a bunch of chart alarms. I think that if you take trades kind of day to day, or like if you position for today to Friday, you've got to be ready for a lot of volatility come Wednesday. I'm probably going to take individual earnings plays, trade the SPY and the indexes alone on Friday, and then try to position for something for the week. So as we're talking about this right now, I was actually going to put this trade in today. So I could possibly revisit the 48.20 if it gets filled. That'd be another big. Let me see if I can get this trade actually. So there's two things I'm looking at. If somehow this market's going to rip this week and try to retest these highs, that's around 52.70. I'm going to put in a broken wing butterfly at 5,300 and try to get filled for. It's the SPX, so maybe I could probably get filled for like 75 cents or $1 if the market's going to come up here.
To end the week, you're saying? One week out?
And this has nothing to do with where I expect the price to go. What I'm looking for is if the market's going to do anything to the upside, okay, I want to see if my credit that I can get on a broken wing butterfly will actually get filled. I don't want it to get to that price. I want my price to be safely out of the way to
No,
collect
I'm
my income
saying,
for the week.
is this something you're looking for to expire Friday?
Absolutely, yes. So this would be a
Okay.
5-3 expiration. So I'm going to look at this right now, and I had it pending in my platform. It's trading for nothing. It's trading for 5 cents. But if I sell the 5,300, buy the 52.95, buy the 53.10, here's what I'm going to do. I'm going to go in to I did not take that trade yet, so I'm going to put this trade in at a net. I'm going to try to get. 50 cents is like low because I think if it threatens, it could possibly do a 75. But I'll try 55 cents. And let me see if I can get this one filled. So
Would
I
it
will
be
do
a negative value too?
so it depends on the platform. So my platform here for Tasty, it shows credit down here at the
Okay.
bottom, so that I can just type in 55 cents and label it as a credit. And a lot of platforms you list it as a negative because it's a debit is positive, a credit is negative. But in this one, it's already positive just because it's listed as a credit. So I'm going 55 cents net credit, good till canceled. If this doesn't fill and I don't get the credit, no big deal. It just expires on Friday without a fill. But if my SPX rallies, through that 51.50 level or 51.60 level, maybe test that 5,200 level. Cool. I could get filled at 55 cents because we'd have, changes in deltas, changes in values for all these option contracts, and I could possibly still collect that 50 to 55 cents by the end of the week. I'll know more probably post Fed on Wednesday. I don't know. Right now, I'm probably saying this has like a 10% chance of getting filled. We're at a 2 delta, which is extremely low probability of getting filled. In order to get my 50 cents, this probably has to be like a 10 or 15 delta, which is not even close to that. So we need to see price shift quite a bit. That being said, I still like the level. If I get the income, I'm certainly going to take it. So I'm going to position for it right now in my portfolio. And then I want to look at the NDX for the same thing. And I'll look at the SPX above and below, because if I did the above strikes where I'm looking to sell up here, I'm going to look to also surround this. So if I can do a, broken wing butterfly here, broken wing butterfly here, I think that's far enough away that price is right in the middle. And so I don't necessarily see price breaking the highs or getting all the way back down to these lows. Therefore, I could possibly get credit on both sides. Does that make sense?
Yeah.
So I'm going to try that. I think that's a good play for me, the SPX. It stays out of the way, gives price plenty of movement to run. For the week, if I go to the weekly expected move, weekly expected move is around 120 points. So that would put me up to, let's say, current price. 120 points is well off the highs, and 120 points is not even at the lows. So if we do the average, I'm well within those means to make money on both sides. If we do, let's say, double that, if we did like a 240 point move, then we're probably going to talk about flirting or testing. 240 points to the downside. That still doesn't get me all the way back to 48.50, which is where I position my my long put butterfly spread, and also to the upside here at 53. That one's going to be closer because we're threatening right now. If we did 200 points, that's close, Frank. That's 183. I think that'd be a good butterfly trade, though. I could easily get my 55 cents there.
It's just very much out of the money.
It is.
What are the odds that you even get filled in even at 55 cents if
Slim.
it's trading at 5 cents now?
Yeah, slim. Slim. But that being said, if we have an Amazon and all of a sudden we're talking about the SPY up here, I still have plenty of time left in the trade to collect the income, maybe. And so here's what I'm doing. I'm not going to adjust my numbers to just get filled on the trade for the purpose of getting filled. I'm going to keep the trade where I think if I want this trade, this to me is where I'm safely out of the way. This is where I'm safely out of the way. I know that if I really wanted to get filled on the trade, I've got to take 5 or 10 cents today. Well, I'm not going to take 5 or 10 cents. There's way too much risk on the trade. I pay all the fees for a 4-leg trade. It's just going to cost me more money. So, if price goes up and I get filled, cool. If price goes down and I get filled, cool. If I don't, it's okay. I can still look at this intraday. I can still look at the NDX as well. But this is how I'm going to start the week. If I'm willing to go out to Friday, I don't need to force trades. There's going to be plenty of stuff that I can trade this week with all the individual stocks and earnings reports, plus the Fed, that I don't need to be forcing a position. So I already have a trade on for the NDX today. That's looking pretty good for full profit. I had a bunch of profits last week. This is 17,970. So if we stay below this, that's a easy dollar credit today. And then I have nothing for the rest of the week. But this is another one. I can do the same thing on the NDX. I'll go up here and look to do a broken wing butterfly with the long call side, and then down here with the broken wing long put side. I don't care if price doesn't fill me right now, but if it goes up and threatens, I get filled. If it comes down and threatens, I get filled, and I still keep that little lottery ticket on the broken wing. So that's going to be my safer place for the indexes this week. You and I will talk all week, I'm sure, offline. I can price out some options for us as well. Amazon. So if we go into, didn't we talk about this last week offline, where I showed like what the expected move was? Let me look at our chat.
It was what was it? 15. Around 15.
What did I calculate here? AI 930. Okay, so that's this week. NDX calls. Okay, Amazon. Oh yeah. So about a $15 expected move. So we've had 8 out of 10 of the previous earnings reports on Amazon have hit the expected move of at least $14.90. So we're trading at 180.61. Positive rip for Amazon puts us up probably to fresh highs. We're not quite at all-time highs yet. Amazon's gotten all the way up here towards 189. But what's kind of nice about this is we stalled at the all-time highs over here. If we have a positive print on Amazon, we could certainly breach those all-time highs. But similar to what we did in Google, Google just blew through those all-time highs. But look at how it breached and then it's starting to fade. So I could see Amazon doing the same type of thing where, we test the levels, we get to that $14, $15 move, and from 180, we go to 195 or 200, and then it fades back down. So I still like it. I still think we position for it. It's not an expensive trade at share prices at 180. There's ways to trade that. So if I looked at Amazon and I want to keep it super cheap, let's go to, and here's another thing. Amazon is Tuesday after market. I don't know if I can just go out to Friday. If I wanted a little bit more time on Amazon, I might want to go out to the 10th. So let's find out. So the expected move would be about 14, 15 bucks. If we're trading at 180, let's say that I did like a 192. That's inside of the expected move. But if I did an in the money bull put spread in 92.50 to 190, so on a 250 spread, I could get $1.80. This is definitely in my wheelhouse for what I'd like to do on Amazon. So if I collected $1.80 out of a 250 spread, I'm collecting 72% of that premium. That to me is a low risk, cost effective way of taking the trade. So $1.75, $1.80. I don't mind that trade. If I did that on both sides, that's a deep in the money bull put spread. We're at 180 right now. If I did the 170, okay, I could collect 350 out of a max $5, and that should be right around 70%. So if I collected 350.
So you're making these verticals basically in the hopes that by May 10th, the price has moved outside of those.
Yeah, and I don't even need it by May 10th. If this happens to be the move on Wednesday morning, if we're coming into Amazon Wednesday morning and Amazon is out here, or Amazon is out here, for me, for the
like 1, 2, I don't know.
Yep. So if I did a 360 credit, okay, and right now, if we come into Wednesday or Thursday's price action on Amazon, if price is out here or out here beyond my strikes, one of these credit spreads is going to be in the money and winning, okay? And so my 362 credit, so here's what I likely won't have. I won't keep the full 362 by next Friday. Not this Friday, but next Friday. I'm not going to wait that long. If price goes outside of these levels, which is what I want to happen, what I could probably do is close this for like a 262 debit, and then I can keep $1. So I mean, if I put 362 in and I walk away with $1 net profit, I'm still pretty happy with that. And there's no way that I have to wait until May 10th. All I need to see is, can we get a $14, $15 move? If we do, easy. I did that on Netflix. I did that on Meta. I did that on Tesla. There's easy ways to trade these where, with expecting good volatility and probably getting it, you can see here that the market's expecting a 14.50 move, right? You want to see what the market's going to charge you. If you want to be long on Amazon, so I think this is probably how I'd play it. It's cost effective. It doesn't cost, I mean, my risk is $1.50 for, if I risk $1.50 and I walk away with $1, I'm pretty happy with that. I can obviously try to play it a little bit more greedy and maybe try to get an extra $1.50, $2 out of it. But this is realistically what I think I'd end up doing on Amazon. If we did a long option, let me delete this for a second. If I just buy the 182 and I buy the 180, right now you are paying the exact amount that the market's expecting to move. 14.54 is the debit to go long at 182.50 and long at 180. That's a call side. That's a put side. The expected move in the IV is 14.59. You're paying that exact amount. So if you want to be long on Amazon, the way you make money on this trade is you need Amazon to blow out earnings and have a big expected move, one way or the other. You want to see Amazon move $20, because if you're going to spend 14.50 to make $20, at least you walk away with $4 or $5 net credit. I
Right.
just don't love that you're paying for every penny of the expected move, and so I try not to do that. Although this is not that expensive. I mean, heck, on Spotify, I paid $21 and made $1. I mean, I made $10 rather. I paid $20 to make $10. That was still pretty good. But to pay 14 and make 4 or 5, still okay. But that requires Amazon to go beyond the expected move. And so the way that you and I talked about earnings is I'm always trying to look at how can I safely calculate this to go the expected move. If it blows through my expected moves, that usually works in our favor. So even with the credit spreads blowing through the expected moves works in our favor. Doing a long trade like this is a long strangle. If it blows through those levels, works in our favor. But here's where it gets tricky. If it doesn't go $15 this week, let's say Amazon only goes $8, $9, $10. Well, I'm not able to cover the cost of my trade. So I'm immediately going to be looking at this trade like, oh crap, I overspent. I'm not getting the move that I wanted. Now I'm going to have to wait. I'm going to have to wait and see if price over the next week and a half will get to that $15, $16, $17 move to get me to break even or better. Or if it actually goes $20, then maybe I get to my profit level that I want. But typically with earnings, I'm not trying to hang on to them that long. I try not to.
Yeah, I don't like strangles or straddles
Yeah,
because, like you said, it is the exact expected move pretty much. So
correct. Yep.
you have time working against you too. It's probably not the best thing in the world. You got to do something like credit and debit spreads.
I
But
agree.
um, yeah,
So
I'm wondering about the SPY though.
yeah.
By Friday,
Hmm.
I do you really think that price has the momentum to test the highs or get close?
Here's how I think it's possible. Okay. Despite what the Fed says, look, we've seen the market this year come out of the gates. It doesn't matter what Powell says. He said zero things different, right? December, the market took it as a pivot because they're like, well, we're going to cut rates and we're looking to, watch inflation, but we're going to cut rates. And the market loved it and ran with it. And then they started to talk it down and say, well, we might be higher for longer. We're going to be higher for longer. Market has not responded to the Fed with negative price action. Not really. So here's how I think it's possible. Look at this list of companies with 900. I mean, we've had like 60+% of companies report earnings. 80% of those earnings have been printing and beating expectations on top and bottom. I mean, we have enough market cap this week between Eli Lilly and I mean, MicroStrategy is not massive, but it's a Bitcoin related thing. There'll be plenty of volatility there. But let's just talk big, right? We did the Mag 3 or 4 last week. Tesla's kind of been tossed and burned, but we had Amazon this week. We had Google and Microsoft last week, but we have Apple. We have the largest company in the world market cap wise with earnings on Thursday. If Apple blows out the water and we have a big move on Apple, that alone has the power to move the entire index. So if you have, let's say everything this week, consensus is earnings are positive all week. It'd have to be a kind of a perfect storm of earnings just crushing it this entire week. And Powell just kind of stays out of the way, doesn't try to, jawbone it down. But between all these companies with all the hype of AI, so you're looking at your, SMCI, your AMD, you've got Amazon as well, which is a Mag 7. But whatever, I don't know what people are calling them now. You've got Apple on Thursday. Yeah, I mean, I again, anything is possible. Here's what I'd like to say. We're starting out the week at the SPY. Let's talk SPY. The weekly candle right now is tiny, right?
Did you see Tesla?
Did I see Tesla?
Have you seen it recently? This morning it
Yeah,
opened up
I know.
pretty high.
I know. I mean, in Tesla, I mean, I was in with a 142. I was in a 142.50 long, and it got up to 165 like the day after earnings. I took my profit. This was a credit spread that I did. We grabbed. Let me see what I have my equities on demand. I think we ended up making. Oh fudge, where is it? Here's my spreadsheet. Equities on demand. I mean, Tesla's crushing it right now, and I think and look, it's not because of earnings. I mean, if you look at the earnings report, if I go back to the daily, Tesla actually missed, right? We had a
I
miss
don't
on
think it
earnings
was
per
the
share
earnings
and
move.
revenue, but it was the thought of they're looking to release. The positive news that the market ran with was they're talking about a $25,000 electric vehicle coming sooner than later, maybe later by the end of the year. And so that could be one of many things the market's like, that sounds good, I'll buy that. So, and also it was so beat up and so bearish. I think that it was just overly positioned bearish for Tesla. So I think this is a short squeeze, in my opinion. I'm not ready to go long Tesla. It'd be nice if I was long. If I was long Tesla at 140 and it's trading up to 180, that'd be freaking sweet. But I just don't think I'm not in a position to be long and want to stay long. I was
Yeah.
looking at still around this $100, $90 level. I was going to show you one thing on, what do we do on Tesla? I think I just pulled up the
We did that
spreadsheet here.
iron condor, but I don't know if you're talking about that.
I think I don't remember what we did. We either did a credit spread or a reverse iron condor. Tesla
I'm pretty sure it was
was
the iron
here.
condor, and
Yep. Pay
we got
1070,
it.
grab $13. Yeah, that's what it was. So I maxed out profit at 15. Now it's trading. I mean, it would be maxed out. It'd be maxed out at $15 by now. But I took the trade the day after earnings. So earnings comes in day after earnings. I'm trading for $13.10, $13.30, $13.40. I just moved everything to $13 and got stopped out there. So I made, $2.30 net, which is around that 20 to 25% take profit, high probability. Fine with that. So it was cost effective to me, and just a trade. So do I do anything at Tesla now? No, I don't care. I mean, it was an earnings play. I'm glad to see Tesla wasn't beat up. What's kind of nice is all my credit spreads that I still have a bunch of 160 and 155s. Those are actually doing great. So that's now, not even a threat for some of my credit spreads to be. They're now, all out of the money, and they'll finish with full profit. So let's do. I forgot what we were talking about
You
here
want to look
on.
at Apple?
Sure.
Because they are reporting Thursday.
That's Thursday after market. Yep.
From what it looks
Somebody's asked
like,
for FRT. I'll do FRT before we're done. We got a couple more minutes. Apple
okay,
is so
their
Apple.
earnings doesn't tend to move it too much.
Agree. And so here's what I'll talk about with Apple. Let's go expected earnings. I'm sure it's single digit. Yep. So this is not going to be a big volatility move. Apple's essentially seen as, I know it's mega cap and I know it's the largest company in the world, but it's kind of a safe haven. It's been that way for a while. It's a company with super big cash reserves, and obviously tech and innovation is important. And I'm sure they're going to have some positive news to get them out of the rut. They've been talking with China a lot more recently, which I think is why they dropped so aggressively early in the year. So I think China, like resuming conversations between Tesla, China, resuming conversations between Apple and China, probably good for longer term growth and having that kind of that multinational exposure. So here is an earnings forecast for Apple. 4.1% is the expected move, and you can see how consistent this is. 4%, 4%, 4%, 6%, 5%. So 4.1 is totally fine. And let's go post earnings. The stock is trading at 174.91 right now, which, by the way, we opened up with a pretty big gap. So I'm not sure what made Apple gap from 170 to 175, but it is what it is. I mean, that's the week so far. We're trading at 174.88, 4.1% expected. So 4.1% at a 174.84. So we're looking at Apple making like a $7 move. $7 to the upside brings us up towards 181 to 182. $7 to the downside brings us back down to 167, 166. If we have a big move on Apple, I think, if Apple goes $10 this week or more, that's a big move because that's, 1.5 times the expected move. But if we look at it from the technical side, yeah, this little floor that we had at 180 could certainly offer some resistance. We could, have positive earnings, get us up to 180 and then fade that back down. Apple could then be stuck in some sideways movement. The one thing that would drag the whole market up, if Apple gets to the highs, Frank, the whole market's going with it, man. I mean, if Amazon was a miss and Google and Microsoft faded back down and Nvidia, like if everything dropped and Apple still went up to all-time highs, that's enough to stabilize the entire S&P. So I think that's what makes earnings so crazy is we have big companies like Amazon, big companies like Apple. If they just have remotely solid price action or positive price action, obviously earnings helps that to be a catalyst, but they're big enough that they can move the entire market. So
Yeah. Well, I guess we'll see.
we will see for sure. Yep.
I'm not convinced that it will move too much just on earnings, but you've seen periods where they beat earnings and just have consecutive days of upside, like going
Yeah.
from 160 to close to 200.
And I'm gonna go back to this, man. I mean, this right here, when we had overbought with divergence all the way up in the SPY, having one correction is usually not enough, right? Like one correction is usually not enough. So I think that this market still doesn't take out the highs. If we're going to come back down to revisit lows, high, low, lower high, lower low. This might take a couple of weeks, but if I was going to put a probability on direction, I would say that the probability is we revisit the lows before we break the all-time highs. I think that's a pretty safe forecast for me right now. Now, if I'm wrong, I'll accept it, which is how I'm positioning the way that I did. If I'm filled up here, if I'm filled down here, I'm still going to try to make income and generate profits. But if I think about this where we are structurally after having such a ridiculous rally, also that's a completion of a fifth wave. If we're going to go 1, 2, 3, I think we retest lows or get into some more corrective territory before this market justifies, breaching or running with all-time highs. That's just my thoughts. So
I'm with you as well. I don't think that correction was over. I think it's the 5,100 on the SPX, which I guess is 510, 515 on SPY.
Yep.
And testing that 50-day, I don't see it going back up to the highs, but the market does whatever it wants. So
it's true. And we're sitting right here for the week to start out on a Monday with a Fed week and all the earnings. We're sitting right in the middle where we could go up to test the high. We could go down to test the low. That's an equidistant move, right? And at the end of it, yeah, it's like at the end of it, it doesn't break the highs. It doesn't break the lows. It's just more indecision with a ton of volatility. So that's a very likely scenario this week with just lots of earnings, Fed, news for the U.S., a lot of catalysts that, ultimately give the market traction to go beyond. So, but like I said, I just don't think that we have the juice to break the all-time highs and just go crazy unless this market's just pure Goldilocks. If it is, then
thing I would push back on is when you say you wouldn't want to see it break the lows or you don't see it breaking the lows, I feel like if we have an explosion to either side, say it's a bearish move, that thing can really drop in a short period of time. So taking out the lows seems more probable than taking out the highs or busting through the highs as hard as it would the lows.
I agree with that. I agree with that statement 100%. And that would be so. And here's another reason. If you take a look at the kind of the velocity that we broke with on those sell trades, I mean, if we breach the lows, I would do nothing more than this. So we high, low, lower, high, lower, low. I would measure that corrective move. I would see how technically obedient it's going to be. If we measure symmetry, I would look to see if we came all the way back down to there to hit symmetry, hit these all-time highs. I'd still be interested in looking to buy into that fall, because that would be getting to that 8 to 9% correction zone. 10%
back kind of everything from this year.
Yeah, it would pretty much erode all the gains for this year, which would kind of suck, right? I mean, to be off to such an easy start for Q1 and then have it all get taken away in Q2. That being said, though, you still have the rest of Q2 to finish out June. You get into Q3, Q4. again, we don't know what it's going to do, but ultimately and inherently, the market is trying to go higher. And companies, I mean, look, you have so much money that's still able to participate in the markets. You also have companies that are getting stronger, stronger, and probably focus way more on cost savings now, because the one thing that AI can bring to the table is cost savings. You can do more with less, right? If you have a company of 10 people or 100 people, it's probably a 5x or 10x multiple of how much productivity that company can now have. So, and I've listened to a lot of reports and read about this stuff. I mean, the idea of, cutting jobs and AI is going to take all these positions away, it's not necessarily that, but it's more like companies don't have to be Apple anymore. You don't have to have a company that's going to be a $3 trillion market cap. You can have a company that has a $1 billion market cap, which is small in the say, from the perspective of these mega cap stocks, is tiny. But you can have a company with 50 to 100 employees that are still making billions of dollars because of AI, because of possibly the evolution in generative AI. So we don't know what that looks like, but as a supplement to productivity, I think that companies can do more with less. And so there's all this money being spent on the infrastructure, which is why Meta got hit so hard last week, because they're going, kind of like they did all in on the metaverse. They're kind of going all in on AI right now, and it could pay out. It could not. Who knows? And I mean, honestly, man, for this conversation, I am looking no further than this week, right? Like I'll trade what I trade. I'll see what makes sense this week. I'll try to position so I can make money up, down, sideways. Take a couple stabs at earnings because we have lots of them. And when the dust settles on Friday, hopefully we're having this conversation and, I'm up a couple bucks. That's all I want to do.
Yeah. Same here.
So
I'm just seeing, I'm feeling the volatility moves this week.
Yep.
So
yeah, I think it's going to be a noisy week. I think at the very least, expect a lot of noise and volatility. You could be up one day, down the next. You could be down one day, up the next. So if you're trading short term and you have some profits, like Nick said before he left the session today, it's a good idea. Especially if it's short term, profits in hand, I would take it. And that's certainly what I'm looking to do around earnings. If I take a trade, Amazon for tomorrow, and by Wednesday I'm in profit, I'm probably just going to take it. If I do something on SMCI or MicroStrategy or Coinbase or Apple, even on Friday or on Thursday to Friday, if I'm up profit, I'm probably just going to take it, and I can just take a sliver of profits, and let's say it adds up to $5 for the week, $10 for the week. If I'm doing that on 10 contracts, it's a pretty good week.
yeah,
So yeah, that's all I need to do.
sounds good.
All right, dude. Well, hey, let's you and I stay in touch all week. I'm sure I might be back onto the A1 sessions. I got to jump into my trading room now. We're gonna start pricing out some options, so I'll keep you posted on all that stuff. But I want to get those SPX and NDX trades in for me, just in case, and I'll put those fills. I'll probably look at the SPX getting filled at 50 to 55 cents, and the NDX trying to get filled at 75 cents to $1. I'll let you know. I'll send you a message on that.
Okay, sounds good. Thanks, Chris.
Okay. All right. Thanks, everybody. We'll see you soon. Take care.
See y'all.
Our Edgefinder anniversary sale is almost over. If you want 40% off the Edgefinder, the absolute best deal of the year, don't wait and head on over to a1trading.com to chat with one of our representatives live right now. This is the biggest discount of the year, and we have so many new features to share with you, like our Smart Money Indicator that directly compares COT data and retail data against each other, or our brand new data scanners with even more useful information and accurate scoring than ever before. Now is the perfect time to get this powerful trading tool because the 40% discount won't last forever. Celebrate the Edgefinder anniversary by grabbing yourself a copy today on our website, a1trading.com.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. And before you go, make sure to take advantage of our massive discount on the Edgefinder for our 2nd year anniversary. Links are below. From all of us at A1 Trading, have a great day, and we'll see you next time. Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. And before you go, make sure to take advantage of our massive discount on the Edgefinder for our 2nd year anniversary. Links are below. From all of us at A1 Trading, have a great day, and we'll see you next time.